So last week, every single thing that we said came to fruition. It avoided these fair value gaps and it went into our measuring gap distribution expectations. This week, I expect it to continue higher into our second measuring gap distribution expectation, but we're going to use our daily profiles from the economic calendar to forecast a vision of what the coming days should do. So Monday has no news. Because last week was a large expansion week, Monday has no news. It's reasonable to expect Monday to retrace slightly and go potentially into this candlestick or wick over here. It could do that. It may fall slightly short, but I do think it will be a retracement day. Regardless, I won't be trading Monday. Doesn't matter what happens on Monday because I won't be trading it. But it should be a tighter range day and it shouldn't go straight up into the measuring gap distribution expectation. Tuesday, however, we have 10 a.m. news, so this is going to be a good day for trading the Black Bell model, which is a 930 volume injection, and the Silver Bullet. It's consumer confidence, so it's not a crazy one, but it does induce some nice volume, and it makes it a lot easier to trade the New York AM session following news like that. So Tuesday would be the day I expect a move into our second measuring gap distribution expectation. From there, we've got Wednesday, FOMC. So FOMC is always, always, always. We know what the daily profile is going to be. It's going to be a consolidation to a New York PM expansion. So the day is going to consolidate for the most part, and then the FOMC will come out 2 p.m., 2:30 p.m. press conference, and we'll start to see some really wild movement. That could take us higher. It could take us lower. I'm not going to predict that because it's a news event. I never predict news events. But Wednesday for me will probably be a no trade day. So Monday and Wednesday will be a no trade day. Thursday we've got a lot of 8:30 high impact news. This is great. It's always going to be a high probability day when you've got 8:30 news. Plus 2022 model. If we can see some measure of manipulation with the 8:30 a.m. news and then see it trade higher into our second or third measuring gap distribution expectation, that would be the most ideal scenario. Then Friday, we again have 10 a.m. news, ISM, manufacturing, PMI, and prices. Same as Tuesday, it's ideal for a silver bullet and for a 9:30 volume injection. So that's the economic calendar done. I'm not going to trade Monday and Wednesday. I'm just going to be looking at Tuesday, Thursday, and Friday. Those are going to be my only trade days this week. And so once these distribution expectations are met, where can NQ trade from there? Well, it's an all-time high condition, so I'm not calling lower prices. However, once these distribution expectations are met, it is technically allowed to go down to these fair value gaps and then continue going higher. So it wouldn't be incorrect because imagine this is a 1 minute chart and it's a 2022 model. You always have to make room for it to trade back down into the fair value gaps that are unfilled and then keep going higher. So it's not something that I think is going to happen within this week, but that can potentially happen over the coming weeks. However, you just want to keep your expectations bullish. If you look at the 4 hour time frame, we've got some relatively equal lows here. However, and this is tricking a lot of people out, but in all-time high conditions, it's going to leave the relatively equal lows open, and it will not take them until price becomes bearish again. And we can't know when price is going to be bearish when we're in an all-time high, because if you're trying to pick the high of an all-time high market, you're just asking to get your head blown off, because that will never be a sustainable strategy. ICT does not have a way of doing that. He said many times he doesn't have a way of picking the high in an all-time high market. So the best, most consistent, highest probability thing you can do is maintain a bullish bias and let it meet distribution expectations, because there's no liquidity pools up here. There's only mathematically calculated distribution expectations. So that means we let it trade up, then we let it retrace, and then we let it continue trading higher. So all you look for is on the retracements, you want to be buying it in order to go higher. Now, if it just takes off immediately at Monday and it meets our distribution expectations, that would be problematic because it means that we really don't have any good trade setups because it didn't retrace. And you know what? That's fine. You just have to miss it and it happened without you, and that's not a problem. What you do not do is try to pick the high and say, okay, it went higher immediately, so I can take my 2022 sell models and I can start looking for the downside. You do not do that. You let it come down and then you look to buy the retracement inside of a PD array that takes it back higher. So this is a 4 hour chart. There's not many PD arrays here. There's just this little stubby order block, this little volume bounce, but these are quite deep. So let's just say it's going to use this wick. For example, this is not a prediction. Then you'd want to be buying around this area in an area that you think price should not breach and then continue to trade higher into the new all-time high, and then into the distribution expectations. So your only focus is to capitalize on retracements and then buy back into the all-time high and then hold for your distribution expectations. That's it. So it should be nothing complicated, nothing more complex than that. So this is the hourly time frame, and as you can see, this is our previous week's NWOG, and this is going to be one of the prices for this week's NWOG. Now we're not going to know the actual price until 6 p.m. today when the market opens up, but when it opens up, it may open lower, it may open higher. That's not what I'm trying to predict here. But when it does open up, I expect some measure of retracement if it opens lower and not like massively lower. So if it opens up here, then this won't count. But if it opens up like there, something that's not crazy huge like the previous one, but say 100 or something handles, 100 handles. We've got this wick here, followed by another wick. What we've got here is a grey pool, fair value gap, and this bullish order block. These two down close candles makes a bullish order block. So we've got 3 PD arrays here that should support higher prices without any clean liquidity to the downside. Now the only liquidity that there is these low resistance lows. However, in an all-time high market, it's a lot more likely to leave these alone and just trade off the PD arrays. So in all likelihood, if it opens up, say here, it can trade down into the order block and then should rally beyond this opening price or this closing price of the NWOG. Use that as support and then keep trading higher. Another scenario that you want to do is you'll want to look at event horizon. So event horizon is the midpoint of 2 PD arrays and can also be the midpoint of 2 NWOGs. So if you take the previous week NWOG closing price, so this was the closing price on Sunday, and then you bring it up to today's closing price, this here is event horizon. So you want this to act as a line in the sand where price does not go anywhere beyond this. It can wick a little bit beyond it, but any body should stay above the event horizon level, and that should act as support going into our second measuring gap distribution expectation. If you found this weekly outlook educational or insightful, consider leaving a like and subscribing. It's free and you can always change your mind. Plus, you'll get a notification when I do another one next Sunday. Thank you.